More, let's bring in Hunter Key, Wolfe Research Director and Senior Airline Analyst, just ranked #1 airlines analyst on this year's Institutional Investor All America's research team. Very many congratulations for that, Hunter, and thanks for joining us.
Hey, thanks, Wilfred. Appreciate you having me on.
In terms of the broader sector, big picture question, first of all, to what extent do you think the industry has sort of mortgaged off some of their key assets, whether that's their points reward system groupings or any other areas, such that even when the market recovers, some of the upside is capped?
Yeah, it's a good question. Airlines have added an enormous amount of debt. The Federal Reserve has been extremely accommodative in terms of allowing airlines to mortgage assets that most people didn't think were this leverageable pre-COVID. So I think it's more a function of just easy money policy than anything else. But airlines still have a lot more they can mortgage in the event that the Fed wants to continue to keep these easy money policies in place. And it's going to probably take this airlines the entirety of the next cycle to pay down this debt. The leverage is going to be up probably 50% during the crisis. I don't think margins are going to get back anywhere close to where they were for the next cycle. So the next 4 or 5 years, if you're able to get through it, are just going to be about slowly paying down this pile of debt that they've raised just to survive. But they still have more assets they can mortgage if the Fed wants to continue to accommodate like this.
Hunter, my question is on demand, especially given what I was just reporting about David Taylor, the CEO of P&G, saying they see consumer habits having changed. Is it just assumed that when we get a vaccine, air travel will return to pre-pandemic growth rates? Or do you think there's going to be a more permanent impact here, especially with something like a business travel? Because we've just changed it up and it's been lasting for months, and in many places it's working.
Yeah, no, it's true. I mean, look, the longer people go without doing something, the more you just get used to not doing it. We did a survey of our clients a couple of weeks ago and asked, what percentage of your business trips do you actually enjoy, or look forward to doing, like, client golf, or just to break up the monotony of the routine or something like that? And it was about 52%. So that's a lot of trips that just unfortunately just don't have to happen. And the real issue there is the types of business trips that aren't going to come back. Those are really the ones where airlines have made a lot of money. Those long, multi-day, grinded out type journeys across multiple time zones where you kind of spoil yourself as a business traveler, buy a lie flat seat on a wide body aircraft. That's going to be the last segment of business travel to come back. That's probably the segment that's going to be most replaceable for people with stuff like this video conference technology. And I don't think that's going to come back next cycle at all. But I think leisure travel will probably come back pretty quickly, but not that end segment of business travel, those really hard trips.
In the short term, Hunter, what sort of percentage share price appreciation would a stimulus bill be worth?
I don't think it's worth anything, Wilfred. I think these stocks roll over as soon as it's passed. I mean, it's trading these stocks of our clients. It's maddening. I mean, you can't do any fundamental work on them. It's impossible. There's no dispersion in the group. The intercorrelation of airline stocks is running at about 0.92. That's well above normal historical averages. They pop as a group. They sell off as a group. There's no fundamental work being done. And when that stimulus package comes, if it comes, I think people are going to start to refocus on the fundamentals. And they're going to realize that they've got all this debt, and they're going to realize they've got working capital headwinds, and they're going to realize that they've got deferred operating costs and capital expenditures. And there's going to be some analysis on the tempo of cash recovery, which is going to be slow and painful, and estimates are too high. So maybe it's worth of 5, 6, 7, 8% or something like that in the pop immediately. And then I think the fundamental work starts, and I think that's when the second wave of concern will probably start to come into the stocks. It's going to take more time. It's going to take more pain.
Shepard Smith here. Thanks for watching CNBC on YouTube.